Hi, this is a video to walk you through Excel model which explains to you how to stress test a money market mutual fund. Money market mutual funds were required by SEC in the year 2010 to comply with regulations that mandate the funds to do a stress testing on their investment portfolio. Having given that mandate, most of the analytical vendors were jumping on the bandwagon of creating a software for mutual funds in order to stress test their investment portfolio. The stress testing that SEC wanted money market mutual funds to do was to stress test them on three different risk areas. The first one is the credit risk. The investment portfolio has securities in them which are usually short-term securities and safe securities such as treasury bonds and some high investment grade securities. These securities were downgraded by two credit grades, two notches, one notch and two notches, and are calculated, the market value is calculated to find out how the credit downgrades has affected the net asset value. The second area is interest rate shocks. The securities are bound to have a price-yield relationship with the yield curve. Suppose if the interest rates are shocked on different ends of the yield curve, what will happen to the net asset value? That is the second area. And the third area is in 2008, when the financial crisis hit the world markets, the money market mutual funds had a unusual redemption of shares from the investors due to panic and multitude of reasons. Because of this, SEC wanted money market mutual funds to stress test on unexpected shareholder redemption of 5% and 10%. Given this three areas of risk where the investment portfolio of a money market mutual fund is going to be stress tested, SEC mandated that such a thing happens on a quarterly basis or a yearly basis. This application is a conceptual model which takes into an account example illustrative money market mutual fund with 12 securities and conducts the stress tests and creates reports based on those stress tests. The application itself is divided into three sections. The first section is the input section, the second section is output section, and the third section is about, which gives you the underlying methodology and the model description. I'm going to press the methodology. I'm going to show you what are the three areas, just as I said to you. Credit quality is one area where the investment portfolio is stress test, and the interest rate risk is another area. The third area is unexpected shareholder redemption. SEC also wanted all these three shocks to be combined in different ways in order to assess the impact of these shocks on the net asset value of the money market mutual fund. During the financial crisis, most of the money market mutual funds broke the buck, as they would normally call it in their industry, that the NAV value goes below $1. And that's a bad sign. They all failed, and SEC promulgated as a result of this to have a regulation for money market mutual funds to stress test their investment portfolio on a regular basis. So let us go to the home screen. The input section has 5 sheets in it. The first sheet is a balance sheet where all the securities are listed and the terms of the securities are also given in columns B up until I. The total assets will include both investments and other line items in the balance sheet which do not carry the stress. You have liabilities as part of the balance sheet which also are not subject to the stress. So the net assets is nothing but the total assets minus the total liabilities, and this is divided by the outstanding shares to get the net asset value, which is 1.03. The three measures that are output as a result of the stress test are the market value, which is inherent in calculating the NAV. Then you have something called credit VaR, credit value at risk. That is a loss that is expected owing to the default or downgrade of the investment securities. CVAR was introduced by Credit Metrics probably in the late 80s and 90s in order to measure the loss expected out of credit downgrades. The third measure is the effective duration, which is typically a measure for calculating the interest rate risk. So these are all the three measures along with NAV completes the results of stress test in this particular tool. There are so many of them, but what this tool concentrates conceptually are these three values and ultimately the NAV. Going back to the home screen, the second sheet that I really want to stress upon is the transition metrics. Transition metrics is a metrics which gives you the probability of movement from one grade to another grade. Suppose an investment security is currently rated AAA, and if it is downgraded to BBB, a non-investment grade, then the probability of such a movement from rating of AAA to a 2 rating of BBB is 6 basis points, 6.006%. So there are totally around 8 states, starting with investment grade, top investment grade of AAA, and down to the default, crossing B's and C's. There are 2 credit rating systems. One is for securities with a horizon of 1 year, and the other one is the commercial paper, which are short-term securities, which has a horizon of 30 days. The complete rating system is different for commercial papers, for which the ratings are P1 to P3, with not rated and default being the last 5 rating grades. The next sheet that I really want to cover is the credit curve. The credit spreads are gotten from Bloomberg, which are market data for all securities with different credit ratings and at different maturity tenors. The third sheet that I want to cover is the yield curve. The yield curve is gotten from Bloomberg also. It's a market data, the previous day's close. And the maturity tenors are in increments of half a year, and there are totally around 10 tenor points covering 5-year period. The yield curve is input into the base YC yield curve, and the forward rates and the spot rates is calculated by the computer as a macro. There are 5 shocks that are given in the interest rate risk scenario. The first one is the base, which is a current yield curve. Then you have a parallel shift of upward 100 basis points and a parallel shift of downward 100 basis points. Then there is flattening with a 2-year pivot and a steepening with a 2-year pivot. I'm going to cancel all the values and use the click button in order to compute the spots and forwards in order to calculate the market value of the securities, finally to calculate the NAV. So I'm going to click the compute spot and forwards, and it's going to compute the spot curve and the forward curves. The last one is recovery rates. Recovery rates are nothing but the historical experience of different types of seniority class of the securities that experience the recovery rate if gone into default. So there are 5 seniority classes, which is senior secured up until junior subordinated. Each one has a recovery rate of 53.8% at the top and 17.09% at the bottom, and each one has a volatility starting with 26.86% to 10.9%. Having given all these input sheets and are done, then I would really want to focus on the combination of shocks. As I've already told you earlier, the credit stress is given, has 3 scenarios. One is a base scenario, which is a current credit rating. Then you are going to downgrade the credit rating of all investment securities by 1 notch down and 2 notches down. So these are numerically numbered as 0, 1, 2. Similarly, the IRR stress are of 5 scenarios. The base is the first one, 0. Then there are 4 scenarios which you already saw: up 100, down 100, flattening, and steepening. The redemption stress is of two scenarios. One is 5% redemption and the other one is 10% redemption. Let's go to the balance sheet, and these are all the values that are going to be computed in order to finally calculate the NAV. I'm going to say compute for this combination of shocks. I'm going to change it to 2, 3 flattening, and then 1 10% redemption. I'm going to go to the balance sheet, I'm going to compute the results, and it's going to tell me the NAV of 0.99, which says that it's going to break the buck, which is less than 1%. So let us go to the isolated shocks only. Here, the sheet covers stressing only on the IRR side or on the credit quality side. So for IRR, the base credit rating is maintained and shocks are given on the interest rate alone. And you compute the market value of all securities and finally compute the NAV at the bottom. Similarly, for credit shocks only, the base yield curve of yesterday's yield curve is maintained, and the credit quality, the credit downgrades are done for 1 notch and 2 notches down for all securities, and the NAV is computed by computing the market value of all the securities. So I'm going to clear everything, and I'm going to compute the results for IRR and CRR only. So it's going to compute all of them and finally compute the NAV. So nowhere during this process of IRR isolated shocks do you see the fund breaking the buck. Finally, the stress test results. Here it graphically represents the NAV under IRR shocks only. As you can see, the up 100 has a down NAV of 1.14 and steepening has 1.2. Similarly, the NAV under credit shocks has 1.14 at the base scenario, and the 2 notches down you have 1.08. So for credit VaR, which is a credit value at risk, for base scenario you have 45,000 of a loss, and for 2 notches down for all investment securities you have a loss of $210,000. So finally, you have the NAV solution space. There are 3 scenarios for credit risk. There are 5 scenarios for IRR and 2 scenarios for redemption risk. So altogether there are around 30 different combinations, and there are scenarios from 1 to 30. So the NAV solution space will cover all 30 of them and find out where all or those stress areas does the fund break the buck. So it's computing right now for all 30 scenarios, and we'll come to know if at all it breaks the buck at any of these stress scenarios. So apparently we are lucky. The stress is not pretty high. Oh, there he goes. It computed successfully, and there you go. There are places where the fund broke the buck on scenario number 22, 26, and 28 and 30. So these are the places where the stress has impacted the net asset value. Finally, you come to balance sheet, and you're going to analyze each security and play around with the values. So if I say money market, Bank of Montreal, all the values of all the terms of the security are coming up here, and if you say calculate, it's going to calculate for all 15 scenarios, keeping the redemption stress at 5%, and calculates the market value, credit value at risk, and duration. So you can check the duration, market value, and CVaR, change any of these values, and play around with individual securities to see if you want to do an uptake of the security or increase the stake of the security. Finally, there is something called the generate reports. All these reports are generated by clicking this button, and it creates 5 reports. All of them are in the PDF format, ready to be submitted to the statutory board or the internal requirement. This doesn't conform to the statutory requirement at this present stage, but it conforms to the internal requirement. So very good. So there are 5 reports. One is combination of shocks, so you'll know which combination of shocks did you use. Then the balance sheet, which has the NAV value and market value, credit wall for each security, and also the effective duration. Then you have the isolated shocks. Then you have the yield curve as a documentation of what yield curve that went into calculating the market value. And then the final thing is the stress test results. So this completes the conceptual model, and if anyone is interested in knowing more about how they could use this model in order to compute the market value, then please send me an email or just ping me on my Eloquence site so that I can come and help you. All these things are run in the background with a macro, so that if you want to use this tool for educational purposes or anything like that, for really testing out your money market mutual fund, please send me an email so that I can help you customize the model for your use. Thank you very much for listening, and hopefully it makes good sense for you. Thanks. Bye-bye.